Thank you very much. Vice Chairman Brady.
Thank you, Chairman. As often as not, a country that undergoes a severe financial America did falls into a double-dip recession within the first two or 3 years afterwards. Given that America's economy is not flying at strong and steady at 50,000 feet, but flying low and slow today, and given U.S. exposure in banks and money market accounts to Europe, do you have any concern that the turbulence from a financial crisis in Europe could trigger a double-dip recession here at home?
I do have concerns about the European situation. I should say first that we have looked very carefully at bank exposures, both to foreign sovereigns and to foreign banks. And in particular, the exposures of U.S. banks to the most troubled sovereigns, the Portugal, Ireland, and Greece, is quite minimal. So the direct exposures there are not large. There are somewhat larger exposures in the money market mutual fund area, but there, too, they have moved mostly away from Portugal, Ireland, and Greece towards the other European countries like France and Germany. So it isn't so much the direct exposures that concern me. Rather, as we've seen in the last few days, I mean, it's been very evident, market uncertainty about the resolution of the Greek situation, about the broader resolution of both the sovereign debt issues and the European banking issues has created an enormous amount of uncertainty and volatility in financial markets. And it's through that volatility and indirect effects, I think, that we're being affected now. I believe that one of the reasons that our recovery has been slower this year than it was last year is that we've faced a lot of financial volatility, and some of that is coming from the European situation.
If there is a liquidity run on European banks, if there's a financial crisis in Europe, what tools are you considering to mitigate, to limit the adverse economic effects on the United States?
Well, first, in Europe, there are substantial facilities to provide liquidity to European banks. First, the European Central Bank has enormous capacity to provide liquidity to the European banks. And as you know, we have conducted a swap line with the European Central Bank, whereby they give us euros, we give them dollars, and on their own responsibility and on their own credit risk, they relend dollars as necessary to European banks that need dollars. So we are doing what we can to cooperate with the European Central Bank and other central banks to provide dollar funding for global dollar money markets. That's the first thing. Domestically, I think our main lines of defense would be to make sure that there is first adequate supervision of our banks, which we are very much engaged in. And I would have to say that the good news here is that U.S. banks have substantially increased their capital bases since the crisis 3 years ago. But secondly, we would make sure that we would stand ready to provide as much liquidity against collateral as needed as lender of last resort for our banking system. Congressman, you mentioned earlier the lender of last resort policy regarding AIG and other individual firms, and I basically agree with you, and just note that Dodd-Frank has made that illegal. We could not do that again. We are not allowed to do any lending to individual firms or to insolvent firms. What we could do is provide with the permission of the Secretary of the Treasury, is provide a broad-based lending program to try to address a run on our financial system, which we do not anticipate, but we will certainly be prepared to respond if anything eventuates.
Well, and I think the question is raised again because of Europe. In financial crisis, it's difficult to ascertain the difference between liquidity and insolvency, and without a clear lender of last resort policy in advance, it lends itself to that uncertainty that we've seen obviously here in the United States, and we're seeing, I believe, in Europe. Can I ask you, are there any other tools you're considering other than the swap lines, creating liquidity with the European Central Bank? Any other tools you're looking at should that crisis occur?
Our basic tools other than those are, again, our supervision and oversight and monitoring of our own financial system. And we are looking broadly at the financial system, not just at banks, as part of our macroprudential responsibilities under the new legislation. And secondly, standing ready, as central banks always have in financial crises, to provide backstop liquidity as necessary.
Can you answer this? We have just a short time left, but you've been reading the papers as I have. There is some concern that the swap lines with the European Central Bank create in effect a backdoor bailout to European banks and leave exposure for U.S. taxpayers. We've had swap lines in the past. My understanding is this lending is to the ECB, not to the banks themselves. But can you address the authority and the potential exposure that might occur?
You said it exactly right, Congressman. The authority is given to the Federal Open Market Committee by the Congress and has been used many times in the past. There's no question about the authority. But in terms of the exposure, as you say, our loan, first of all, is really, it's not a loan, it's a swap, because what we're doing is we're swapping dollars for euros with the European Central Bank. We have a contract with the European Central Bank that they will return to us the full amount of dollars plus interest that we give them. So we do not face any exchange rate risk or any interest rate risk. Moreover, they make the loans to their own banks about which they have appropriate information, supervisory information and the like, and if there are any losses, they are responsible, not us. So taxpayers are under no risk whatsoever through these swap lines, which, by the way, proved very, very helpful during the 2008 crisis.
Thank you, Chairman. Yield back.
Thank you, Vice